Hi friends, so this is the second video in the Captive Insurance Learner series. In the episode 1, we introduced the concept of captive insurance as an alternative risk financing tool. We also discussed what are the various general benefits of setting up the captives. We discussed type of risk which can be covered under the captive insurance and the risk where traditional insurance markets are not so good. So if you look at the organization type, there are various ways an entity for a captive insurance company can be set up. So before I discuss the organization type, I would like to explain what is a captive domicile is. A domicile is a state, territory, or a country that licenses a captive insurance company and has primary regulatory oversight over that captive insurer. So if you look at non-US domicile, most of the organizations or the captive insurance companies are set up either as a stock insurer or as a mutual insurer. In US, other than these two, that is stock insurer and mutual insurer, a captive can be also set up as limited liability company and reciprocal company. So as far as the term captive domiciles are concerned, we would be having a separate video on that. This video is limited to the various organization type and structures only. So what is a stock insurer? As name suggests, it's like any other company where the captive insurance company sells stock to raise capital from the company. And whatever the profits are generated, they are distributed as dividends. They are returned as renewal credits or return of premium. And stock insurance companies or stock captive insurance companies are benefited by limited liability like any other company. Mutual insurance companies. So we already discussed about mutual insurance companies in episode 1 itself. For a quick recap, a mutual insurance companies do not issue stock and it is owned by policyholder called members who funds the captive by contributing surplus. Profit of captives are returned to the policyholders. Second type we discussed was mutual insurance company. Actually, we have discussed in detail what is the mutual insurance company in the episode 1 itself. But for quick recap, a mutual insurance company is an incorporated company and it is also having a limited liability. The fundamental difference between a mutual insurance company and a stock company is that the insurance company do not issue stock and it is owned by the policyholder called members. And these members fund the captive by contributing surplus. Surplus is kind of capital. Profit of captives are returned to the policyholders. Third type of the captive is limited liability company, or LLC. A LLC sits somewhere between the stock company as well and mutual insurer. And LLC do not issue stock, but it does offer limited liability to its members. It is relatively new structure compared to other form of insurance companies or captive insurance companies we discussed. Fourth type of the company we discussed was reciprocal organization. These are primarily unincorporated associations. So reciprocal organizations are licensed by Domicile, in which it is organized as captive insurer. These reciprocal organizations are run by something called Subscribers Advisory Committee, that is SAC. Subscribers are similar to insured for a traditional insurance policy. And these subscribers share the risk among themselves and contribute surplus. This Subscriber Advisory Committee, that is SAC, grants the operating authority to an attorney. This attorney runs the day-to-day operation of reciprocal organization. So any income or profit which is generated by reciprocals is allocated by SAC to Reciprocal Subscriber Saving Account, that is SSA. The main advantage why people or the organization wants to cover themselves with a reciprocal organization is the tax deductibility of profits which is allocated to SSA. These profits which are distributed to SSA, later distributed or passed as tax-free to the subscribers. Risk retention groups are owned by multiple businesses with similar insurance needs. So these are primarily a group captive insurance company. So risk retention groups were first allowed by passage of Federal Liability and Risk Retention Act. This act allowed group to form captive in one state, governed by that state's regulations, but also engage in providing insurance businesses in other states where it is not domicile. Most risk retention groups do not only require members to pay the premium, but also contribute capital. So as I told you, a risk retention group is formed to cover similar types of risk by the various businesses or various members who are participating in that risk retention group. So for example, medical malpractice insurance in US for doctor is very expensive. So one example for a risk retention group can be medical practice liability insurance. In US, the premiums for medical malpractice liability insurance is very high. So there are various groups of doctors who have formed these risk retention groups. So for example, a captive can cover a liability for $1 million each accident and $5 million in aggregate for a doctor. And each doctor may be asked to have a deductible of $25,000. On top of that, the captive can cover a risk up to $225,000. So that is total $250,000. And beyond that, they can get premiums at very competitive rates because it becomes lucrative to the normal reinsurance markets. And this is how the risk retention group become very competitive compared to traditional insurance market. A risk retention group can have their own underwriting guidelines to include or exclude the risk. As I already told you, setting up a captive requires a long-term commitment and it requires certain minimum capital. In certain cases, an organization may not be interested in setting up a captive. They may not want a long-term commitment. They want to test the water, or simply they do not want to get involved into administration of a captive insurance company. In those scenarios, they can rent a captive, and these are called rental captives. As name suggests, a rental captive rents its capital and surplus to policyholder for a fee and provide its own administration and reinsurance. Other than fee, a policyholder may also need to provide collateral other than the fee what they are paying. Policyholder usually have less control than the single parent company because these are run by third parties. And being a new form, there are various structures available for rental captive, and in some cases, the tax consideration may not be fully settled. So one need to take a call based on what are the positive and negatives. So in a rental captive, term renter can be used similar to insured in a commercial insurance environment. Other than the insured or the renter, there are other parties called sponsor and manager. So sponsor is basically the company or the firm which set up the overall captive and provides the capital. And they appoint another firm or company. Mostly these may be a related company or it can be a law firm. These are called managers. They manage day-to-day operations. So what is the advantage of setting up rental captive compared to the traditional single parent captive? So in a rental captive, there is no upfront requirement of the capital from the renter side. The rental or the capital is provided by the sponsor. There is no administrative hassle in managing a rental captive because it is managed by the managers, as well as the cost of managing the captive can be lesser than managing a single parent captive. There is more flexibility of a renter to join and leave, so the exit provisions are easier. You get the same benefit like making underwriting profit, investment income, and the exit provisions are also easy. What are the disadvantages? Primary disadvantages of rental captive is that it is being the new form. In certain structures or certain forms of a structure, the tax deductibility and rules may not be very clear and there may be ambiguity in some of the areas. Insureds may have very limited control compared to a single parent captive because it is sponsored and managed by another party. Other disadvantages of a rental captive can be that returns and profit may be subject to certain deductions of fees by the owners. Very few domicile allow for setting up of rental captive. Not all domicile allow that. So rental captive the renter need not only pay the fee, but which is in place of premium, but also need to provide the collateral in form of the letter of credit. And many times, even if you exit from a rental captive, it takes years before you get your collateral back. It depends on what kind of program you are. So rental captive can be structured as either a risk sharing model basis or no risk sharing model. A risk sharing model is similar to buying an insurance from the commercial market only, except that you are buying it from a rented captive. Whereas a non-sharing model is also known as segregated captives, protected cell captives, or simply cell captives also. Segregated or protected cell captives, also known as cell captives, do not pool the risk. These are based on segregation or separation of each participant's account. So what happens is that the assets and liability of each cell, despite they are part of the same captive structure, are not shared. The assets of one cell cannot be used to pay the liability of another cell. So this can be only done if the members of the separate cell have signed an agreement where the liability and assets can be shared. Otherwise, they are not allowed. So protected and segregated cell model is getting more popular, but it is only allowed in certain jurisdictions. So what is the advantage of a cell captive model is that there is no capital requirement like the rental captives, lower operating cost, quicker to set up, same tax benefit as you get in the single parent captive. The main advantage of the cell captive over the normal rental captive structure is that there is a segregation of account or an underwriting, which means that each program for the cell can be customized to as per the needs of the renter. Second thing is that you can take advantage or premiums are based on your own risk management practices and not necessarily based on the other parties or members. Exit provisions are far more easier here. So main reason why most of the companies who opt for cell captive do so for the reason that there is no capital requirement to set up a cell captive. Second reason is that they are segregated and separate from other captives owners. If you are a part of the other rental captive, you will be sharing the risk. Here you are not sharing the risk. So it is more similar to the single parent captive risk rather than a group captive. But you have the advantage of group captive that there is an easy exit, there is no administrative hassle, and easy to compliant. So what are the advantages of segregated and protected cell captive over other rental captive? So like the rental captive, there is no requirement of capital, there is a lower operating cost, and they are easy to set up. You also get the same benefits as you get in a single parent captive. So primary reason why people go for cell captive is that there is no requirement for capital and there is a bankruptcy protection also. The cell captives are required to capitalize each cell separately based on actuarial calculation and risk profile of each cell. We will also discuss about the captive owners. So captive owners are primarily the sponsor or company which set up the captive. From the rental captive perspective, the captive's owner can be usually the association group or captives, agency captive insurers, and a special purpose vehicle. So what is association group captive? As the name suggests, these captives are formed to serve as members of a specific trade association or industry. For example, a medical malpractice liability in US is mostly written by association group captives. Whereas the agency captive model is formed by mostly insurance brokers. They provide the capital to set it up. They are the sponsor, and mostly either some of their affiliates or group companies are manager also, but that is not necessary. Most of the cell captives are set up by the agency captive insurers. Special purpose vehicles are the captive insurance or captive reinsurance company rather being set up by the insurance companies. These special purpose vehicle or SPVs underwrite the risk of their parent insurance company. These are formed primarily to securitize the risk. The insurance companies reinsure their risk from the SPVs and then this SPV sell these risk as a bond in the security markets. So in this video, we have discussed about the types of the organization, the way captive can be set up, the various possible structures of the captive insurance companies. We also looked at what are the main captive owners for the rental captive insurance companies. In upcoming video, we will be discussing about the various domiciles, especially the popular ones. What are the advantages of these domiciles? Tax benefits of setting up captive insurance companies, and we will see some of example of various captive insurance structure. Thank you so much for watching this video. If you like this video, please subscribe so that you can get the notification about upcoming videos. Thank you.